Welcome to the All Financial Hour podcast with Steve All.
Big news here. The Dow Jones Industrial Average is again in milestone territory. It recently surpassed the 40,000 barrier. And while this certainly deserves some attention, let's be honest, some folks don't even really understand what that means. Steve, I want you to break that down. And what does it mean for like our 401k?
The idea around it is I think a lot of times we have to be careful because the indexes, it's a good gauge for returns. But a lot of times we'll have people come in and say, well, the S&P 500 is up X and my 401k is not up that much. I want to do something different. And I look at it and I said, I think we have to get the expectations in line. If you have a 60-40 portfolio because you're a moderate investor, that means you got 60% of your assets in equities and 40% in fixed income. To expect to make the return of the Dow, which is 30 stocks, or the S&P 500, which is 500 stocks, all equities, is not a fair comparison. So that's why I think we have to bring those expectations back into line. And then the other thing that we have to look at when we start talking about returns is the time frame that we're talking about. Different portfolios, a 60-40 portfolio, if the market's down, could outperform a 100% portfolio if the markets are down. Why? Because there's not as much exposure to the equity side of it. So we have to give ourselves the time, and we also have to look at where we're at on that risk-reward scale. That's why when we bring it in, we're going to find out. We're going to ask those questions. I like asking the simple question. 1, on a scale of 1 to 10. 1 is I'm conservative as you can possibly be, and 10 is I'm as aggressive as you can possibly be in the market. If you couldn't pick 5, which one would you pick? I only say that because most people picked 5. So which way do you lean? Do you lean towards more aggressive or more conservative? So they go over there and they say, well, I'm a 3 or a 4. Mm-hmm. And then I'll ask the question, okay, what are your expectations for returns? Well, I'd like to get 10 to 12%. And I'm going, well, those are kind of, I want to be ultra conservative, but I want an aggressive portfolio's returns. So getting those expectations in line, I think, can be very advantageous for people because it is very difficult to say, I want a 10% annual return, but I don't want to take any risk to get it. So that's one of the things that we do when we bring people in. And that's what I love about Brad Jenkins and Market Guard. I have that availability. If you're a 10 on that scale of 10, I've got all stock portfolios that are very aggressive. If on that scale of 10, you're down there in the 2 to 3, I can get those 40, 60 portfolios that help match up with your risk-reward desires. And I also have the availability to be static, more of what buy and hold and adjust for drift, or I can be more tactical, where it will actually move away from the market, like right now. People will say, well, why would you be moved a little bit away from full market right now? I said, well, we've got a few headwinds coming at us right now. We got a Federal Reserve, and we're not sure if they're going to raise rates or lower rates. We've got a little bit of a problem over in Israel. What about the Ukraine? We have a presidential election coming up. We've got inflation and interest rates. So we've got a lot of uncertainties going on right now. So it might be a good time to be defensive for those that makes them more comfortable. And I think having that availability to take the emotions out of investing, I think having that proprietary investment methodology that's non-emotional, mathematical, and methodical. It will move away from the market when the logarithms say it's time to, and it'll move us back in so that we're not making our decisions based on emotions. So if you're looking at your returns on your 401k and you have questions at it, and you're over 59 and a half, give us a call. Let's do an analysis around your 401k to see if we might be able to assist you in the future.
A recent study found that people know more about Medicare, life insurance, Social Security, and even long-term care than they do about annuities. In fact, annuities finished dead last. The number one fear of people in retirement is running out of money. It's a problem that annuities can help solve, but only 10% of Americans have one. So what's the problem here, Steve?
I think the problem of it is what I like to call old ideas. Annuities have been around since the Roman Empire, so they're not anything that's brand new. But a lot of the older contracts, a lot of the complaints that I hear, the single premium immediate annuity. I gave my money to an insurance company and I passed 4 or 5 years later and they kept my money. Single premium immediate annuity. Then they could say the variable annuities. Well, they had very high expenses in them. So people complained about the expenses. And then long surrender periods. I mean, when I first got in the industry, some of these were 17 and 20-year surrender periods. High surrender charges, about the same contracts. Long surrender charges, and a lot of those things that have come about. But a lot of those things have changed over the last 10 to 12 years. When we start to look at annuities, a 10-year surrender charge is probably long. 10 or 12 would be the longest surrender. 10% has kind of been the top on the surrender. And remember, you only pay the surrender if you get out of the contract early. So it's not something that you're going to pay anyway. The other thing that a lot of people used to complain about was agents' commissions. Agents were paid tremendous commissions 10 or 15 years ago. And it was like, is that an incentive to assist the agent, or is that an incentive to assist the client? So that's the things that used to happen. They still can today. As I like to say when people say they don't like annuities, I don't not like annuities. I hate a lot of annuity salespeople. I hate it when you come into my office and you've got pensions and Social Security that are $2,000 to $3,000 a month more than your living expense. And I look over here and you have an annuity with an income rider. I don't need that. You don't need it. You look at it and say, Steve, I could turn on the income, but I don't need the income. Why were we sold these? I look at it as the right tool for the right job, I think can be very, very advantageous. So that's where I say, let's look at it. Interest rates are high right now. If you have an annuity that you're not really sure how in the world it's going to work for you, give me a call. Let's do an annuity x-ray and find out what the best way that you can do with that annuity. If it's got an income rider and you haven't turned it on, might be able to do a partial surrender and turn on some income over here, or completely remove the income rider. If you replace an annuity, you might have a longer surrender period. So that would be a negative was come through it, but we'd have to make sure that it's better for you. And if you've got a gap between your, quote, lifestyle expenses and your current income and the assets to set it aside to guarantee it for the rest of you and your wife's life, why not? Why not? The right tool for the right job. So if you have an annuity and you're not sure, give me a call. Ask about that annuity x-ray. If you're looking for protected growth, call. Ask about the index annuity to figure out how it could help you. And I will state, yes, we sell annuities, but we're also full service. We do investments, we do life insurance, and we do annuities. I want to have all the tools in the toolbox to assist you in your retirement.
Stock prices are testing all-time highs, and some big names out there, might know a few of them. Jeff Bezos, of course, Mark Zuckerberg, and the Walton family, of course, known for Walmart. They have already sold off millions of dollars of their company's stock. One analyst tells Fortune magazine that the cash out could be due to the election possibly shaking up things this fall, maybe leading to a downturn in share prices in the next few years. So for those investing for retirement, just regular folks like myself here, what could this mean? And I know on top of a lot of folks' mind is, are we headed for a market crash, Steve?
I look at it when people start to say things like that. Divestiture of some of their holdings is important for everybody. Most large people like that, they have selling plans that they put together where they are going to liquidate some of their holdings. The Walton family. Mm-hmm. They sold like $1.5 billion in Walmart stock in a month.
Wow.
The Walton family owns 45% of the Walmart shares. So, yeah, they are going to sell. They're not going to hold everything they have in just one holding. Now, if they sold it all, I might start to get a little bit nervous. But you start to look at things like that, I think that just normal divestiture, when insiders, it does account for a lot of times. We do look at that when insiders are buying or when insiders are selling. I wish I had the opportunity to sell $8.5 billion worth of Amazon shares.
Yeah, right.
I don't care what the taxes are on. I just wish I had the opportunity to do it. So that's not normal for most of us. But Vince and Sherry had come into the office They had a pretty nice portfolio, probably about, $2.7 million. And about 35% of it was in one stock.
Wow.
That's a lot of money in one stock. And that one stock, if it goes down, the amount of troubles that could cause could be great. So if you're in that condition and you had a large holding from the company that you worked for or somebody that you inherited, whatever it is, how do I divest of that? Or what are my options? Mm-hmm. One, you could sell it all. Okay. But if it's got capital gains in it, you're going to pay capital gains tax, which in most cases is lower than ordinary income taxes. You might sell some of it. You might look at it and say, okay, let's buy the shares that have the highest cost basis in them so that I have to pay the least amount of taxes possible, so that we're actually diversifying ourselves from that holding and we're shifting those dollars to other companies, other assets. Or you can just hold on to it. Those are the three options that everybody has. And so we have to look at it and say, which is the best option for you? Because your situation is going to be different than Jeff Bezos and the Walton family. They're going to go from that. What would be the best? Should I diversify some of these positions? Should I just hold on to it and pass it to my children? How would it affect your plan if this large holding did fall down in value? Would it change the way you're retiring? I think that's why having a full plan together is the most important thing that you can look at. So we can look at things like this and see how it would affect you. So if you're one of those people out there heavily invested in a single stock, and you'd like to come in and talk about how we might be able to reduce some of your exposure to that and possibly limit taxes on the sale of that asset, give us a call now. Ask for that risk-reward analysis, and I'll sit down with you and we'll look at that holding that you have and say, what are the ways we could reduce the risk, diversify your, quote, overall holdings, and possibly pay the least amount of taxes possible.
From Mark Zuckerberg, Jeff Bezos, all those rich folks, it makes you wonder, how much have America's richest saved for retirement? Turns out it's less than you think. According to a new survey, the top 10% of households by net worth had an average of $1.29 million in their retirement accounts, like IRAs, 401ks, those type of things. And that sounds like, it could be attainable even for, those of us that don't consider ourselves rich. But I guess what are the basics to getting there, Steve?
The thing of it is, I think Albert Einstein said it. The most powerful thing out there is compound interest. When we start to look at it, if you were 20 years old and you put $2,000 a year into an IRA account and you could earn 8%. Now, do I have a place that you're guaranteed 8%? No. We're just using that for a number. And at age 65, if you could do that, you would have $834,000 in an account. That's halfway almost to the number that you're looking at. If you waited till you're 30 to start, you would have $372,000, less than half. And you only put in $20,000 more. If you wait till you're 40 to do it, you'd only have $98,000. So the biggest thing that we can look at is how to get started. Start now is the biggest one. Well, I get the question a lot of times, well, Steve, I can't go back to when I'm 20. What do I have to put in now to get that same $834,000? If you're 55 when you start saving, you got to put about $53,000 a year into an account. Mm-hmm. Not as easily obtainable. So the idea around it is pay yourself first. I can still thank the gentleman that when I first started in talking to the guy who was my financial advisor, and he looked at me and he said, Steve, if you don't pay yourself first, you're never going to have the money. He said, because I'm going to promise you, as your salary and wages go up, so will your overhead. If you wait to save dollars on what you haven't spent. So that's when I talk to a lot of people, 80-10-10 rule. Take 10% of what you make, put it towards your retirement. If you can put 15%, that's even better. Take 10% of what you make and give it to wherever you get your faith. and live on 75 to 80% of the money. The biggest problem that I see with people when they come in to retire is that they're living on 100% of their income and they got credit card debt. Because if you learn to live on 75% because you're given 10% to your faith and 15% towards your own retirement, you're always going to be living on less than what you're bringing in. And I think that's the most important thing. You have to pay yourself first. I don't care if you're 25 or you're 40 or 55. But the idea, the best time to start was yesterday. And if you haven't started yet, the best time to start is now. If you haven't done anything, it's difficult for me to bring you as a client, but call and ask for that 15-minute consultation. I'll sit down with you and we'll just sit and talk about how you could get started. If you're out there and you're not sure if you've got enough money, I don't want to be a burden to my children. And that other question, when can I retire? Give me a call right now so that we can sit down and do a comprehensive retirement plan for you to find out, can you retire? Because a lot of people, when they come in and go, wow, I thought I had to have X number of dollars to retire. No, you got to have enough to meet your lifestyle. Fixed income, Social Security, pensions, and your lifestyle are the most important things. The money that you save in your retirement plans is for the extras. Give me a call now. Ask for that comprehensive retirement plan. Let's find out, can you retire now? And if not, when could you?
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.